Hello, everyone, and welcome to today's Traders Mind Chat show. Yes, we are rebranding again, going back to the original title of the show, Traders Mind Chat. Why? Because everything involves mindset and trading psychology, and we'll get into why. But before we do, I want to share with you today's topic of the day, what we'll be discussing today, and why you're all here. Let's make this a little bit bigger here. We're doing a stock market deep dive today. Now, what is a stock market deep dive, and what do I hope to share with you today? The purpose of today's show is to give you a tangible process that will provide deeper, clearer, and more timely market insights. You're going to see how this works in real time and with the current market. Here's what we're going to review today and why we're going to review it. The first thing that we're going to review is market mood and the various components of it. I have this whole color coding system of red, yellow, and green. We're going to go through that and how you can implement this for yourself. And the big reasons why we're going to do this is to help give you precision, right? Something that you could do yourself. Precision, speed, give you information that is unbiased, where you don't have to go to me or go to some guru, listen to the news or any of that, anything else. You're just going to be able to look at the market, read the data, and come to your own conclusions. That's one of the big reasons why we're doing this. And also to help you know how much to size, aka how much should you be risking. Now, before we start, if you know of someone that you'd like me to have on as a guest, we're going to be doing a lot of guests, have a lot of other insights into the market. If you know someone or know of someone like, hey, I follow this guy, could you uh, interview this person? Reach out to me, let me know. We are streaming all over the place. There's so many different places. So wherever you happen to be watching this, just type into the chat or drop a comment later on if you're watching a replay of this. I read all the comments and I will reply to them. That also goes for questions, right? So if you have questions, go ahead, type into the comments, ask your questions, fire away. I want to help you as much as I possibly can. And the way that I'm going to be able to do that is by you actively participating. So whether you're watching this live or you're watching a replay later on, drop comments and I will respond to them. All that said, let's get into it. So, what is this market traffic light system anyway? Right? So here's basically what it means. This market traffic light system, when it's a red condition, that means that conditions are not so great. Conditions are poor. And so when conditions are poor, we want to limit our size. We want to limit our risk. When conditions are yellow, moderate size, average, normal sizing, standard risk. And green conditions, it's a good market, time to size up, time to put on some more risk. Now, the way to look at this, or the way that I look at this, is through this lens right here. These three vectors, and they meet right in the center, this Venn diagram. And so there's the general market, your system, and personal performance. I've outlined it in this way, so that way all of it is completely customizable. There's always going to be the general market condition, right? So if you walk into the supermarket or if you walk into a sporting goods store, you're going to buy a car, whatever type of market you're going to the stock market, you're going to the crypto market, you're going to the Forex market. There's the general market, and the overall environment is going to affect how other types of trades are going to behave. So that's why we want to take a look at that overall general market. And we want to come up with our own definitions of what that general market is. And I'm going to share with you what I do and why. And again, as you have questions, please type them into the chat. Next is your system. So that includes all the different setups, your screening process. Again, no matter what it is that you're trading, you have a system. Whether that system is good or not, we could talk about how to create a great system, but I'm going to share with you how I go about screening and some of the setups that I use and why and how I go about defining them. And that'll help you to start to model something where you could make this your own. And finally, personal performance. So part of all this, right? Let's say that you were to go to the store and you bought your favorite, I don't know, your favorite apples, right? Not the company apple, but you just your favorite apple that you're going to eat. You go, you pick it up, looks good, you bring it home, all of a sudden this thing is rotten in 3 days. You find a worm in it. That's telling you that what you bought wasn't that great. That tells you something about the overall environment. You should have a mechanism where you could see how good the market is. You could see how good your system is. And if your personal performance, if those two, the first two, the general market and your system, are leading you to the best opportunities, then your performance should be good. If it's not, then that's something that's going to tell you that, hey, maybe things are starting to change. Maybe I should start to size down a little bit. I see some questions coming in already. Uh, Question on Instagram. Hey, Michael, great system, a great stream. Thank you for the general market conditions. What do you check to determine conditions? We're going to get into that right now. So let's jump into the next slide for general market, right? So here's what I look at, and I'm going to share with you too actual current market environment and how I analyze the market for today and heading into tomorrow. So general market. Uh, these are the things that I'm looking at for the general market. If it's not here, and if we don't mention it, then there's a pretty good shot that I'm not considering those things, right? So I'm not looking at the mainstream media. I'm not looking at newspapers or any of that stuff. I'm looking at what's here. So for the general market, I'm looking at the S&P 500, the Nasdaq, the New York Stock Exchange, the Russell 2000, and the Dow. So I'm looking at stocks. I'm interested in growth stocks. I want to take a picture of the entire landscape, but I don't want to just look at it through one time frame. I want to look at it across time frames. So that's why I've got the daily, the weekly, and the monthly time frames here. So let's take a look at some charts, and I'll just gonna bring this down over here. Hopefully you guys can see this okay. Now we have the daily charts of the major indexes. We've got the S&P 500 over here, the Nasdaq, the Russell 2000, the New York Stock Exchange, the Dow. And I also like to look at the IBD 50, Investors Business Daily. There they take their top 50 stocks. They tend to look at growth stocks. That's what I'm interested in. So I like to look at that as well. So the thing that I saw with each of these here all started to roll over about a week or so ago, right? Like just as the new year started. And so on this time frame, on the daily time frame, this as of yesterday was making lower lows and started a short-term downtrend. So did the Nasdaq. So did the Russell. And the NYSE and the Dow had started to move sideways. They weren't making higher highs. They weren't making lower lows. They were just moving along sideways. On the weekly time frames, right? A little bit of a different picture on the weeklies because, well, what might look catastrophic, right? Like that, I wouldn't call this catastrophic, but what could look rough on a daily time frame, you zoom out a bit, and all of a sudden, maybe it's not that bad. Maybe this is just normal action. So this started to push lower, and it did push lower than this week over here on the S&P. So that started short-term downtrend. So did this. But even with these two, right? Even on the Nasdaq over here, well, what do you notice? You notice that it's starting to come into that red line right there. That's the 10-week moving average. That's a spot where your major institutions of the world, right? So your major hedge funds, pension funds, those big players. That's where they tend to step in and start to defend positions. Why? Because they can't move like you and I can move. It takes them days, weeks, sometimes even months to acquire the number of shares that they want to acquire. So they're not flying into and out of position. So when it starts to drop to a level like that, that's where they might step in and start to accumulate. Russell drop below this week's low over here, so short-term downtrend. This is still reasonably holding, right? So this is still potentially sideways. This is still sideways, potentially even an uptrend, depending on how you're looking at that. You take a look at the weekly charts, and the monthly charts, I mean, and the monthly charts, you wouldn't even know that there was any trouble in paradise at all, would you? It's it's very helpful to get this kind of perspective when you're looking at this overall market environment. That way, you're not sucked in one way or the other way. You're getting the overall broader picture before you make any kind of decision. And that's going to be important to whether you are long term, intermediate term, a day trader, a swing trader, whatever style whatever your time frame is, having the lay of the land is going to be very important. So that's one thing that I'm looking at for general market. The next thing, right? And again, as you guys have questions or comments or thoughts, please type them into the chat. I'm trying to keep a look up here on Instagram. Uh, Everybody else, I believe that you show up on my streaming software over here, and I'm also looking at Rumble down there. So go ahead and make your comments. Make yourself known. This here, distribution day count. What does that mean? A distribution day is a down day on any index of at least 0.2% or more on heavier volume than the day immediately before it. This is something that one of my trading heroes, trading mentors came up with years and years and years ago. This guy's name is William O'Neill. He's the guy that founded Investors Business Daily. We talked about the ETF a minute ago. What he discovered was that when you start to get days like that of 0.2% or more on heavier volume than the day before it, when you get a bunch of them in a row, then that means that you could see heavier selling pressure in the market. You could start to see chop. You could start to see a deeper correction. So that's why he's tracking them. So I started to track them. And he didn't just look at a couple of years, he looked at markets going back to the 1800s. Very thorough historical look back that he did. So when I'm looking at this and I'm considering this, I'm going to take a look at, well, what is the distribution day count? And what I noticed, we'll take a look at the S&P 500. I have a script that helps me track all this distribution. Years ago, I used to track all this by hand. And I still have this other tool called MarketSmith. Maybe we'll take a look at MarketSmith, but right now we're using this here. This is a charting platform called TradingView. I'm using TradingView, or one of the things that I like about TradingView is that they let you code all different kinds of things. So you could code whatever it is that you want. One of the things that's important to me, these distribution days, I have it flagging how many distribution days there are. So every single distribution day gets flagged, and you might see that little number there. I'm not sure if you guys are able to see it or not, but it's keeping track of how many distribution days there have been over the last 25 days. So over here, right, well, when we had Wednesday, that distribution day, that was the fifth distribution day in the last 25 trading days. So it's starting to get a little bit heavy from that perspective. But what's even more important from my studies and from other studies as well is that when you get 4 or more distribution days over the span of a 2-week period, so about 10 trading days, that constitutes a distribution cluster, and that in itself can start to cause the market to run into some serious trouble. So we had that here, right? That as of yesterday, one, two, three, four within the span of 10 trading days, that could lead to some serious problems. And then the next day, well, what do we get? So far, we had the on Thursday, the S&P undercut Wednesday's low, closed at the low of the day, closed just below that purple line, which is the 21-day exponential moving average. Today, so far, maybe it's getting support, maybe it isn't. Price so far is bouncing between that purple line and the green line. That's the 21-day exponential moving average and the 10-day exponential moving average. Yeah, you're having buyers and sellers. Both of them are coming in all over the place. So what did we say earlier? When you get distribution like that, it can lead to chop. Not an ideal market environment where you're just making money super easy, right? Where stocks are breaking out. You're in a choppy environment. So now you could take that into account as far as your position sizing goes. Next up, new 52-week highs versus 52-week lows. And I see a few questions coming in from YouTube over here. Right. So let me read through this real quick before we move on. Mike, happy new year. For sell into strength, why not sell when you see stock drop by 3-5% as trending? We'll get to those kind of questions towards the end. Let's keep it topical for now. Yeah, some more questions about selling to strength, and then taking a look at uh, a few trades. Yeah, if we have time at the end, I will gladly go through all specific trade examples, selling into strength. If we don't have enough time for it, then you have two options. First option, you can wait until next week and we'll try to make a live stream on selling into strength. If that's what you want, if that's what a lot of you want, go ahead, type into the chat and let me know if you want me to do a selling into strength live stream next. Great. Would love to do it for you. If you want quicker answers, I'll give you a way to work directly with me when we get to the end. But right now, let's keep going with this. So, new 52-week highs versus new 52-week lows. What is that and why is that important? So, 52-week highs and 52-week lows I find to be very, very important. And the reason why is because when I take a look at the major indexes, right? And I'll take a look over here at the Nasdaq. Um, turn off the annotations. Well, we'll get to all that color coding momentarily. But right down here, if you see this, this is tallying up just every single day. It's tallying up the number of stocks on the NASDAQ that are making new 52-week highs and new 52-week lows. And when the ratio is favoring the new highs, it's green. When it's favoring the new lows, it's red. When it turns black, it's starting to transition, right? So when you have a streak of red, new lows, then it's red. A streak of new highs, it's green. Black is transitional. So what I learned when I went back, and I went back as far back as TradingView allows me to go on the NASDAQ. Years and years, right? So where does it go back to? The new highs versus new lows goes back to 2001. So from 2001, there's no significant uptrend without the number of stocks making new highs outpacing the number of stocks making new lows, right? So like even over here, right? Like this over here, sideways action, but the price never got going. Eventually, it rolls over, and what happens? New 52-week lows start to proliferate. Then you get the new 52-week lows drying up over here, and then once they're done drying up and you start to get some more 52-week highs, that's when you start to get this little bit of an uptrend over here. So new 52-week highs doesn't mean that price will go higher. It doesn't mean that the index will go higher, but in order for it to, you have to have that. You have it all through this. Once you start to get new 52-week highs drying back up and new 52-week lows start to proliferate, you start to get markets rolling back over. And to bring things back to where we are here, right? We had the solid uptrend. So this is going back to the COVID lows, 2020, right? So back over here, let just to predate it a little bit, 2019, moving into new highs, moving into new highs, all these new highs. What's happening here? The number of new highs dramatically outpacing the number of new lows. Then all of a sudden you get a little transition period in there, right? Some chop, then new highs again, and then all of a sudden, and back here, before you get the major, the worst of it, before you get the worst of it, you start to sell off over here. You start to sell off a little bit more over there. New lows are starting to outpace new highs at this point. Then, right there, off the high, you're down about what? You're down about 10% or so, 11%. You don't have to wait until you're down 30% to say, "Uh-oh, maybe I should lighten up. Maybe I should sell some shares. Maybe I should get defensive." This is a very early warning system, and it's not something that you need to wait for anybody to tell you about. You could track this yourself. You could have all those indicators available. Figure that all that stuff is free in TradingView. It's just a matter of knowing how to use these tools. So that's a new 52-week highs, new 52-week lows. Any questions there? All right. Uh, yeah. What does the monthly time frame tell you? I mean, it tells you the monthly performance, but how do you interpret that in terms of the market? I usually only check the hourly, daily, and weekly. So that's a great question, and because it's such a great question, I'm going to go back to these charts here and discuss it a bit more. So, well, what does that tell you? Well, right now on the S&P 500, where's price? Price is getting back towards the prior high. So if price is getting back towards the prior high, well, what would you expect to happen, especially if you've run up pretty far, pretty fast? You expect a little bit of choppiness, right? Well, from the monthly perspective, you could see that things are fairly copacetic, but it's when you start to drill down to the weekly, things look a little worse over here. Things look uh, a bit more choppy over here on the daily, right? Get back over here to the daily time frame. But what about, well, like you might be able to spot that on a weekly chart. Well, why do we need this monthly? I'll show you why. Because sometimes it's not just looking back to 2 years ago. Sometimes you need to look back a couple of decades. Back here from July 2000 over to here, right, to October 2007. Why did the market sell off there? Oh, well, the housing crisis and all the shenanigans that were getting pulled by the big banks. That's why. Well, what about the price action, right? You're just marching along, new highs, right? Everything's just gonna go real nice and smooth, right? Well, there's plenty of technical reasons why you might hit a ceiling at that level. Then over here, price comes back, retests that, then all of a sudden starts to move back up, and it's over here, right? The S&P starts to hit some resistance and consolidates for June 2015, right? That general area until finally starting to break out over here in December 2016. Well, you can't move up forever, right? Maybe that's a coincidence stopping there, right? Wrong. The indexes are related to one another. When one starts to pause, it tends to affect the other ones. So, how did it happen back there in 2015? Take a look at the NASDAQ. NASDAQ peaked February 2000. It wasn't until June and July that it finally started to get back to its prior 2000 highs. The same exact time when the S&P 500 started to get into trouble. Coincidence? I don't think so. So that's where having this broader perspective of monthly timeframes can come into play. Maybe you're able to spot that on a weekly chart, but to look at 15 years worth of data, it's a lot easier for me to spot it over here on a monthly. Let's see. A couple of other questions coming in from YouTube. Let's see. That makes sense. It can help you spot and confirm trend. Yeah, great. Okay. Any other questions before we move on? Just scrolling through Instagram here. No? Okay, good. All right. Moving right along. All right. So let's talk about system. System is the number of stocks that you have that are passing your screens. If you're trading crypto, if you're trading forex, if you're trading something else, maybe your system includes something else, but a different screening way, perhaps. But you should have some sort of a universe. You're not going to be interested in every single stock in the market. You're just not. There's 10,000 or so stocks in the market. You're not going to trade all of them. Some of them will fit your style, your edge better than other ones. So those narrow the field down. That's your universe. You're trading Forex, you're trading crypto. Same thing applies. Some cryptocurrencies, some Forex pairs will fit your particular style better than others. So that's your universe, narrowing the field down. Next is your trade ideas, the stocks that are setting up in patterns that you trade. So we all have certain patterns that we trade, whether you happen to be aware of it or not. Some people's patterns are, well, I just heard about this idea on Twitter. This guy that I respect said it. So I'm going to go and buy this. Guess what? That's your setup. Is that a great setup? No, that setup is terrible. You could do a lot better than that. So what kinds of setups uh, do you trade? Well, what kind of setups do I trade? Allow me to share with you some of what I trade. Right. So I have. I was going to show you this earlier. I'll show this to you now. This is the market mood log. So every day where we were talking about market mood, general market, I'm tracking all that stuff here in a spreadsheet. And looking at this visually helps me to see uh, how the market is performing and how conditions are changing, and do that in real time. And it's helping me to scale up and scale down. Now, let's see. What did I want to show you in here? I wanted to show you uh, setups, right? So here's what I look for as far as setups go. And I also have this in a spreadsheet. And this is what I would recommend, the level of granularity. If you're trying to make 2024 the best trading year that you can, let's say that you want to have a 5-star year. We've spoken about 5-star years a couple of times in the past few live streams. If you haven't seen them, go back on whatever platform you happen to be on and check those out. But for now, uh, what could help you have a 5-star year is to get super duper clear on what your setup is. So give it a name, then start to describe it. What time frame are you looking for this particular setup on? How long is this setup? Is it a couple of days, a couple of weeks? How long is it? How about the depth of this thing? Is it a couple of percentage points? Is it pretty wide? Describe it. Jot all those things down, right? Oh, depth of pattern near the pivot and those things that's a little bit more advanced. I'm happy to talk about that with you later on. But to keep things moving, you want to come up with the look and the character of uh, of your pattern. So, does it look like a cup with handle? Does it? Some of the things that I have here for a pullback buy. I'm looking for stocks that pull back into the 21-day exponential moving average. I want the slope to be no more than 45 degrees. So I don't want to see super steep pullbacks. I like it to just kind of glide in and then get ready to bounce, right? All the things here, market type required, placement in the trend, all these things are important. And then later on, you want to see, well, what's going to take these things from good to great? Right? Because sometimes you'll find a pattern and the pattern will be, all right, it's okay. But what makes a great pattern? Because you want to trade more of your great patterns, your A level setups. Focus on those. Those are going to be your more high probability setups. Those are going to be the ones that make you more money over the long term. And then once you have your setups defined, start to find models of those and annotate them. I'll share with you one that I've annotated, right? So this pullback, this was one that I saw in Zscaler. You might take a look at this and say, hey, I spotted another kind of pattern on here. Maybe I see this as a double bottom. I'd agree with you. Uh, but this is also could constitute a pullback where prices consolidating right around that purple line, that 21-day exponential moving average. It also has the 50-day moving average right there. A couple of other things that I like to see. The stochastics start turned up over here. The relative strength line is starting to outperform the price. This is a model of what I want to see when I'm looking for a pullback. So when I go and I look through all the different stocks on my universe list, if they look like this, then I know, aha, that's one that I want to investigate further. Does that make sense? I hope so. Right. So uh, let's see. Saw another question come in. This one looks like from Twitch. We just started a Twitch channel. Hello, sorry for bothering you. I want to offer promotion of your channel views. Okay, so yeah, any kind of promotion or anything like that, just reach out to me. We could talk offline about things like that. Great. So how does trade ideas affect this overall landscape of the market? Well, if you were to just go to whatever market you're trading and the quality is great, right? Like you go, you do your analysis, you're looking at your universe, there's more stocks passing your scans, you look at the trade quality and you're finding stocks that fit your model, then that's a great time to be trading, right? That's giving you insights about the type of market environment that you're in. And that could affect whether you're going to be in that red zone, yellow zone, or green zone. If you're finding great setups, well, as far as this over here, that circle is concerned, you're in the green zone. But maybe you're looking at the general market and you have a whole bunch of distribution days and the number of stocks making new highs are drying up. Maybe new lows start to outpace the number of new highs and the general market is red. Uh-oh, you've got one red, you've got one yellow, one green over here. What should you do? Should you be sizing up? Should you be scaling back down? What should you do? You could come up with any kind of rules that you want. I'll share with you what I do in that kind of environment. I'm playing what is the weakest link. You remember that game show? Yeah, so if there's one of them that's red, I want to be sizing down. I'm fairly conservative when it comes to risk and risk management. Let's see here. There was another question that came in from Darren over on YouTube. So you're trading setups mainly, it sounds. Yeah, like I mentioned earlier, anything could be a setup. But to more accurately describe my style, I'm looking for breakouts, and I'm looking for breakouts from what maybe you might consider advanced areas, right? So it sounds like you have a little bit of experience. So if you're trading a classic setup, let's say a cup with handle. Let's see. Do I have a cup with handle over here? Let's take a look at this here. Yeah, so over here, right? This was an example of a cup with handle, and your classic pivot is right there. I'll take that trade. But sometimes I'll also be trading this, right? That downward sloping trend line uh, as prices breaking back above the 21 period moving average. I want to try to buy as close to the danger zone, meaning where I'll stop out at a loss as I can. And I want the danger zone that I'm looking at to be as have multiple layers of support on it. So if price just breaks through support, then that means that there's something wrong, something seriously wrong with the chart. All right, great. Um, Another question that came in, along with technical analysis, do you do any fundamental analysis, meaning check the company's quarterly reports, research? Yes. So that part of it comes in during the screening process. So the question from Darren, and this is a great question. I'll show the question. So along with technical analysis, am I doing fundamental analysis? And this is a great time to get MarketSmith up. So let me go grab MarketSmith and see if I can show you that real quick. Yeah, so here's MarketSmith. MarketSmith is playing nicely today. So I will run a variety of screens at the end of each week. And most of these over here are based on fundamental aspects. I'm looking for extraordinary earnings, extraordinary sales, high ROE, things like that. And I will screen the market for those kinds of things. And that will build what I call my universe list. Right now, as you can see over here, thanks for the question, Darren. As you can see, there are 406 names in my universe. That's the most that I've had in a while. So, as of last week, I run these screens once a week. As of last week, there were 406 names that passed my screens and fit the criteria to be in my universe. So, once a week, I'll go through this list, I'll prune this list, add names, kick names off. And as more and more names pass my fundamental screens, that's telling me from a fundamental perspective that, hey, things are starting to get better here, right? And if I'm actively tracking that, which I am, and which you can too, get MarketSmith out of here and go back to this log back over here, right? So I'm actively tracking the number of stocks on my universe. 406. Week before that, 395. You can see that going back to yeah, right around here, right around late October, things started to make the turn and started to increase week by week by week, more and more. Well, what happened to the general market at that time, right? Well, what happened to the indexes from October to more recent, right? Here's the S&P. Here's late October. All of a sudden, we're starting to move up. So that's how things like this can end up playing with one another. And the thing that I want to be careful with for myself and to express to you is that we don't want to get sucked into any one criteria, any one thing that we're looking at. It's so easy to get caught up in the minutia of any one indicator or signal or one of these circles over here. It Do the analysis first. Get all of the pieces of the puzzle first, then start putting them together. And then once you've got it all set, then come to your conclusion of, hey, things are looking good, things are not looking so good. I should be scaling up, I should be scaling down. And then that gives you a much more complete picture. Let's continue. All right, let's see here. Darren says, wow, this is great. Thank you. You're welcome, Darren. uh, Personal performance, right? So once we get down to over here, your personal performance, you want to consider the trades that you're holding. Are the trades that you're holding currently at a profit? Are they currently at a loss? How long have you been holding these names? Have you been holding them for a couple of days, a couple of weeks, a couple of months? How long have they been holding? Are they just running and giving you more and more and more profits? Or are they just kind of meandering around, not doing very much? Are they running? Are they consolidating? Right? So sometimes you'll be in the middle of a trade and I'll share with you, let's see what Zscaler is doing now. So this was one that I was in right now. I'm in cash. It was in this trade. I got into this trade back here, back in November 13th, and was in it until uh, this day here. I sold at the open and was out of the. I sold bits and pieces along the way. Not sure if you could see each one of those little horizontal lines, but sold a small token amount there. Sold a bit more here. Sold a good chunk up here, and then sold the last bit on the open right there. And so uh, what was I getting at? As far as performance goes, as far as are they running? Are they consolidating? Well, at this point, back here, right? This was running for a little while. And then in here, things started to consolidate, right? So that's early December. What was the market doing in early December? Early December, the market is also consolidating and consolidating constructively. Maybe this might be a good time to either continue to hold positions or maybe it's time to add positions. Maybe it's time to add to this position. Hindsight would have been a good idea, but this wasn't really a setup quite yet. So I held, and price continued to run up and run up and run up, and then started to consolidate a bit more. Over here starts to get wonky, right? I raised my stop aggressively and stopped out at break even over there. And that was January 2nd. Stopped out, moved to cash. That's right here. Pretty close to the top. All right. Question from Darren. Darren, you're on fire with your questions. Why would you add during a consolidation versus selling or holding or adjusting your stop loss? Great questions. The answer is it all depends on how price is consolidating. So once you've been trading for a while, you're able to start to decipher what's normal versus what's abnormal. Well, what's constructive versus what's not constructive. What's going to give you good reward to risk and what isn't. And in this area over here, price was wide and loose, right? So if I take this little measurement tool over here. Let's say that I wanted to enter over there. Oh, that's actually not too bad. Maybe as far as reward to risk goes, it's a 3% risk. If I was looking to take some profits over here, maybe it's about 2R. That could have been okay. Yeah, in hindsight, that one could have been okay, reward to risk, but price was fairly choppy at that point. From a probabilistic perspective, I didn't like this that much as a setup. So that's why I didn't take it there. But that's the kind of nuance that you start to evaluate. Is price setting up? Is this providing you with the type of setup that you're interested in? Type of add-on area? Uh, is it a good quality setup? Then yes, yes, great. How much should I add? If it's not, you want to give yourself multiple ways to sell. There's a whole thing in my book that I talk about with members called danger signals. To share danger signals with you briefly, let's bring that spreadsheet back up. Where's the spreadsheet? Spreadsheet over here. Have this danger signals. Right? I've got a whole bunch checked off that I was using this tool on another trade that I was looking at. But danger signals. Well, what are danger signals? Danger signals are something that's telling me that the market is starting, or the a trade that I'm in is starting to lose momentum. I want to be in stocks that have momentum on its side. When too many of these pile up, that's telling me, hey, danger. Time to either exit completely, raise the stop aggressively, or do something thereof. And depending on where I'm at in a trade, I'll give the stock more room or less room. This could be a whole live stream by itself. We're already way of it, but that's okay. We'll keep going. So you want to uh, look at the stocks, how they're running, how they're consolidating. You want to look at not just the trades that you're holding, but you want to take a look at how your last 10 trades have performed. Sometimes if the market's hot, you might have 10 trades in the last week, depending on your style. Sometimes if the market's cold, it might be a month and you have 10 trades. So that's telling you something too about the market environment. Are you seeing a lot of opportunities pop up? Yes. Well, then that's telling you something about the market environment. If you're not seeing a lot of opportunities, that's also telling you something. How those trades are performing. Are they giving you small gains? Are they giving you massive gains? Are most of them getting stopped at break even? Are most of them generating losses? That's going to tell you if you should be aggressive or not. Should you be scaling up? Should you be average sized? Should you be sized down? And that's going to be the best way that you're going to keep money in your pocket, because if the market conditions start to get unfavorable and your performance is starting to suffer, the way to dig yourself out of a hole is not to continue to dig. The way to get out of the hole is to first put down the shovel, and then you start to put on smaller positions, smaller test positions, smaller risk. You start to gain some traction there. And then once you finally do gain traction, then you could start to reevaluate and then start to build on strength. Then take profits from the trades that you're putting on that are now starting to work and use the profits to build bigger positions. You don't want to start scaling up when you're in a drawdown. That's a quick way to blow up your account. Uh, Trust me, I know from experience, learning things the hard way. So let's see. Well, what else? Let's take some questions here, right? Before I get into that, see if there's any other questions that you guys have. All right. So, if you like this and you want more, you have a few steps to follow. Step one, wherever you happen to be watching this, we're streaming all over the place. So wherever you happen to be watching, subscribe to wherever you're watching from and set alerts from wherever you're watching. So if there's a little bell or whatever that is, make sure that you're clicking the bell, make sure that you're subscribing to the channels. Great. Step two, if you want to learn more from me, I publish a free newsletter every Sunday that has lots of education in it, that has the trade ideas that I'm looking for the week in it. You could get that for free. Go to marrowwealth.com/newsletter and you'll be added to the newsletter. And finally, if you want me to coach you, we've got that too. Go to marrowwealth.com/premium and I'm happy to teach you everything that I know and more. And you could ask questions all day, every day. Well, we meet on Discord. We do 2 group live coaching sessions per week. And there's a lot more in there. So go to marrowwealth.com/premium and you could learn all about that. So let's see what other questions you guys have. I'll stick around for another moment or two. Darren says, "You were recommended to me. Love the content. This is great. Don't you also have a group?" Yes. So in the premium coaching, it's group coaching. You get access to our private Discord. So it's not just me. We have other coaches in there. Uh, this other guy, Stu. If you happen to see some of my other content, uh, we had the trading mind wheel virtual conference. What's a trading mind wheel? That's my book. Stu spoke there. He is one of the coaches in our program. He started out as a member and has been doing so phenomenal that we invited him back to be a coach. He agreed, and Stu has become a very good friend over the last several years. So yes, you get access to me, our other coaches, the whole community. The community is wonderful. Well, we consider ourselves family. We had a Christmas party, virtual Christmas party. People logging in from all over the world. It truly is a wonderful experience. Let's see. I think that there was a question here from Jawei. Let's look at Coin and Square. Hopefully, Jawei, you're still here. But even if you had to go, you could leave comments later on. And this could hopefully be helpful for other people that are here. All right, so let's see. Your question was selling into strength. Why not sell when you see the stock drop by 3%, 4%, or 5%? It's hard to sell and see the stock go up. As a trend following, we should not predict. All that is true. And all of those are reasons why I like to scale out into strength. I don't like to move to have all or nothing. I like to sell bits and pieces on the way up. I like to give myself multiple ways to exit a trade. So just like if you went to the movies and you go there, you're sitting there, you've got your popcorn, you've got your drink, and you're getting ready to watch the show. Before the movie comes on, what happens? They tell you, oh, there's an exit over here, there's an exit over there, there's one over there, there's one right behind you. I like to set up the same thing for a trade. So the exit right behind me, what's that? That's the stop loss. The other exits are telling me I want to sell into strength. I want to lock in profits as I go. I want to have an exit that's telling me when the trade is beginning to sour. That's what all those danger signals that we were talking about earlier are all about. And I also want to have one about the backstop. That's where, remember, we were talking about price breaking support, like you're walking on a floor and then all of a sudden you fall through a hole. That's what support is. That's where I want to keep the stop. So something like coin, right? There were a couple of spots to enter coin. I have it marked over here, and coin was one that just ran and ran and ran. So with this, I would be selling some into strength fairly early, right? So 5%, 10%, sell some, right? And for me, on average, if we take a look at multiple years of trading for me, my average gain tends to be roughly 10% on each trade. So let's just say that we're exiting a portion at that average. Okay, 10%. 10% is way down here, right? So let's say you entered here and you sold. For me, 10%, I would have taken off half there. And then all of a sudden, price keeps on running up and you feel like a stooge, right? Well, if that's you, then that's less of a, well, you could look at it in a couple of ways. I actually think that it's less of a strategy problem. I think that it's more of a mindset problem because of the way that the question is phrased. Because if you're judging yourself saying that, oh, I'm a stooge for selling so early, look at this thing there that ran. What you need to be looking at is your data. Nobody can predict the future. Nobody knew that, hey, this one is going to go up 70%. If we did, then well, you would have taken your whole account, put that in because I know that's a winner. But nobody knows what's going to be the winner, what's going to be the loser. Well, we take the trades that the market gives us and we manage risk in real time. So you have a mechanism to sell some into strength at different points. I like to sell into strength when I hit my average gains. I then like to sell a bit more into strength when I hit what's called the high watermark. What's the high watermark? That I'll take a look at what the past 10 trades have done and how far have those winners gotten. Have they gotten 10%? Sometimes they only get about 5% if the market conditions are rough. Sometimes when it's a very strong market, it'll get to 20%, 30%. So at that point, right, like I had Z Scalar, I was taking out gains at about 25%. So at that point, that was telling me, hey, the market is doing well right now. Let your trades run further. So that's why I'll observe my performance and let that be one of the gauges that I'm going to use to sell into strength. And these are all things that you could do yourself that uh, that you could allow your performance to be the guide where you're customizing a system to fit you. And perhaps best of all, you don't need to wait for anybody else to tell you what to do. You're allowing the market to speak to you. You're looking at your own data and you're trading with absolute confidence because of all that. Uh, yeah, so floor, right? Like, so price starts to move up over here. And then let's say that you are raising your stop loss, right? So let's say that you had your stop loss over here. And let's say, oh, you notice that it's holding that green line. It's holding the that green line, the 10 EMA. So price uh, sort of pulled back to it over there. Then it rallied. So keep the stop over here. Then price moved up higher, pulls back to it, and then starts to bounce around and then moves up higher. So maybe you're raising your stop below the floor that it's set over here. Then price starts to accelerate some more over here. So maybe you keep on raising your stop progressively. Price moves up higher over there, raise your stop up a bit more. Then you see price making this parabolic kind of move over here. Maybe you're keeping your stop way down here, but does that really make a lot of sense from a reward to risk perspective? You need to keep the math in mind when you're managing risk. This is how trading can start to become complex. This is how trading can start to become a bit nuanced. This is the difference between looking at this as a hobby where it's just like, yeah, I'm going to buy coin and ride it to the moon versus actually taking money and putting it into your pocket and making this a real thing that you could do. So price continues to move up. And let's just say that you're in over here. Price runs up another 30%. And so what? Are you going to leave all that on the table? Or are you going to raise your stop? Maybe you're going to sell a bit more into strength somewhere along the way, right? So price gets all the way up here. If your stop is down there, and let's say, where do you think price is going to go? Maybe you think that price is going to go to 200, right? Psychological resistance point. If price is up here at about 180, to get to 200, it's only another 12%. If your stop is still way down here, down at support, the last time that it made support, then you'd be risking 20% to make 12%. That makes no sense. So from a reward to risk, you always want to be getting odds on your money, right? So tighten up your stop if you're going to continue to play for some more. And that's the idea there. So Jai Wei, I hope that answers your question. And again, for those of you that want more, step one, subscribe wherever you happen to be watching from. We're streaming all over the world. Make sure that you are subscribed and that you set alerts. We do these kind of live streams every Friday at the same time. Number two, make sure that you get on our free weekly newsletter. We provide all sorts of valuable free education in there. I provide the trade ideas that I have for the week ahead in there. Go to marrowwealth.com/newsletter, and you'll get the next one this Sunday. And finally, if you want to work directly with me, be a part of our team, have me coach you directly, go to marrowwealth.com/premium and learn all about what's included in there. There's a lot too much for me to ramble on about now. But I hope that you found this valuable. If you have more questions later on, just drop them into the chat. I read all these chats and I do my best to answer all the questions. We'll be doing a lot more of these types of things as the year goes on. But now, take care, everybody. Much love. Peace out.
Hey, thanks so much for sticking around to the end. If you're new here, hit the subscribe button down below and become a part of the Marrow Wealth community. And make sure that you check out some of the other videos on the channel. They're exactly what you need to see. And leave a comment down below. I read all of them. Leave a comment.